Good morning and welcome to class 46 of 50, net amount at risk. Yeah, we call it reverse engineered product option alternative, which really relates to saving money is making money. Reverse engineering, it's a cornerstone of our Math.Logic.Wealth course, where we share each week what we know to help your prospective clients get the best deal possible. And that makes you the most effective and professional insurance advisor possible. You know what reverse engineering is, right? Taking something apart to see how it really works. And we do it for one reason, to get your clients the absolute best deal. How good? Well, how about saving over $80,000 on a $1 million policy? That's not a typo. Let me show you how. Take a typical scenario. A 60-year-old man wants $1 million in coverage. The standard approach is to ask, do you want your cash value added to your death benefit? When the client says yes, boom, they're suddenly paying $24,720 instead of $21,479 a year for 20 years. We've calculated that's a 13% difference your client doesn't need to pay. But here's where we flip the script. Instead of starting with product pushing, we start with something like an approach to RSPs. Think about it. Would any professional ask, how much do you want in your RSP when you retire, without zero context about inflation and earnings or tax implications? That would be like throwing darts blindfolded. Yeah, you can do planning, you can make a bunch of assumptions, but there's only one logical way to do this math. We call it the allocation method. First, we engineer the right numbers for each of your financial buckets. That's the real financial planning, not selling. So you ask the person, hey, how much do you want to put into your RSP this year? That's what most people do. And then you manage it, right? We connect clients, or these clients should try to find the top product experts who commit to ongoing adjustments as part of their service and maximizing the return for the RSP. This is what true professional insurance advising should look like. It's about mastering the numbers, understanding the mechanics, and using that knowledge to create value, real value for your clients. When you can show a client to save 13% through proper mathematical analysis, that's not just selling insurance. That's delivering professional expertise that makes a measurable difference. That's where our network is headed. It takes a village, and we're learning together. I can't wait to see what we discover next week. How is that for an intro? So the first slide I'm going to is reverse engineered. So your toolkit can include the lowest cost permanent life insurance policy. So let's challenge conventional product thinking. Yes, insurance companies offer policies with increasing death benefits and growing cash values for lifetime access. But here's what they don't emphasize. Why might someone specifically want a policy without cash value? Consider this. Corporate-owned policies often avoid cash value because it complicates capital gains tax. The cash value gets included in corporate share valuation at death. That's one practicable reason, but let's get even simpler. Remember last week's example? Female, age 90, 1 million policy with zero cash value. Two powerful insights emerged. Think about it. The ability to direct a significant tax-free death benefit at age 90, to have control over $1 million of cash, non-taxable cash. That's what I call planning power. Now, I let you fill in how powerful that is, but at age 90, cash value becomes almost irrelevant. Now, which is more likely, using a complex bank loan to access cash value, or simply using the beneficiary designation to direct where that million goes? This is what reverse engineering reveals. Sometimes less product complexity means more planning power. Add this to your product toolkit. It's not about what you can add to a policy. It's about what you might strategically leave out. So here's a picture of your insurance policy. So what's an engineer's superpower? They take scientific principles and transform them into real-world solutions. They analyze, design, build, and create to solve problems. Does that sound familiar? That's exactly what we're doing with life insurance. But here's where it gets interesting. Engineers don't just follow blueprints. They use creativity, and not the let's brainstorm sales tactics idea. They're talking about deep analytical creativity that comes from understanding how every piece fits together. Think about what we've built together over these 46 weeks in this class. Each of you has contributed to something bigger, a network of professionals who believe consumers deserve to understand exactly what they're buying. We are putting a stake in the ground here. When a client asks about allocating their resources to life insurance, we can now show them precise measurements and comparisons. No guesswork, no sales pitch, just clear engineering principles applied to financial decisions. Remember class 10 when we covered YRTUL. That was just the foundation. Now we get to show you the complete engineering blueprint, the math that makes everything work. Next week, class 47, we'll tackle longevity calculations. But today, let's go back to basics. Let's rebuild our understanding of life insurance from the ground up, starting with this powerful tool, the beneficiary designation. It's not just a form to fill out. It's an engineering control mechanism that belongs entirely to the policy owner. This is where creativity meets precision. Think like an engineer. How can this simple mechanism be used to solve complex financial planning problems? So here it is. I'm making it come alive. The provincial legislation. Here's the amendment. This is what it says in the provincial legislation. You can. It doesn't say maybe. It doesn't say, well, we'll take a look later at this. It says you can. And what it says is you can designate a beneficiary or beneficiaries, your choice, without restriction. So how does life insurance work? We have a simple foundation. Here's what it looks like. Now let's think about this like engineers about the foundation of life insurance. The basic principle never changes. Pooling mortality risk. But how we structure that risk, that's where our reverse engineering comes in. For 30 years, the optimal design was lap-supported term to 100 inside universal life. The math seemed perfect. Minimum funding, pay for life, permanent coverage, all guaranteed, great price. But here's what the engineering analysis missed. Human behavior. People didn't lapse. Not because they were financial geniuses, but because of inertia. Like watching paint dry. Just keep paying the premium. It's like your monthly bill for hydro. This design flaw forced a product evolution. Today's landscape? Our whole life with cash value dominates, maybe 10 times more of the premium dollars flowing into our industry than what's going into universal life. But our reverse engineering reveals something fascinating. YRT to 85 inside a universal life chassis represents what an engineer would call a dynamic adaptive system, a design that maintains flexibility to respond to changing conditions while managing risk parameters. It's an essential component of a diversified life insurance portfolio offering adaptability that a single par product cannot match. Think of it like designing a bridge that might withstand not just today's conditions, but unknown future stresses. Engineers build in multiple support systems and adjustment mechanisms rather than relying on a single rigid structure. That's what we're doing with today's class. The lapse built into the pricing model and guaranteed for life upfront, insurance costs and fees are guaranteed. We can actually show the math and compare it to everything else. The engineering beauty, lowerly cost creates higherly cash values. Yes, there's an incentive to quit and let the insurance company off the hook, but that's transparent product design. The challenge and the opportunity, those increasing insurance costs need active management. I believe this is life insurance's future. Just like any investment, you pay for what you get. The risk of you dying increases as you get older. Yes, cost increase because risk of dying increases. Now, I'll show you the math, but let's go through how we have modified this picture. There we have the premiums going in. I said it was a choice, and it is a choice. We calculated it, right? And we talk about interest, and we say, oh, the play is to maximize it, and we will try to maximize it. But as we go through this, we come to the final piece, the part that really screws up everything, which is what's happening to insurance costs and fees. Can you control it? And we want to minimize those. So guess what? Choice is now changed to calculate and pay attention. The maximize is now par fund has become a universal life option. Isn't that incredible? You now have that same investment option inside a universal life, all being offered now and recently by the big three insurance companies. That's a game changer. And finally, we got the minimize the cost, but you don't have to worry about it. They're guaranteed. They built in everything. They're locked and loaded, as I like to say. So let's go. We're almost done. We're going to do the math. How does net amount at risk reduce the cost? It took me a long time to get here, but let me go. Let me keep going. Here's the first one. Let's dive into the engineering mathematics of the design. Here's a real example, 50-year-old, showing exactly what our reverse engineering reveals. They start parameter is 1 million of insurance, 3% policy credited rate. YRT to age 85, 20 pay, funding structure. That's our baseline design choice. We don't want to go longer than 20 years because now you're just throwing more darts into a blind place. Now let's analyze what the numbers show us, right? An engineer would focus on two critical assumptions here. The first thing we focus on here in our model is the price. I should have showed that first. So the price for these two are different, 19,127 versus 15,790. And the next thing we go is to the cash value. Now look at the cash value column, right? You're going to see that the cash value on face plus fund is higher. These are exact proportional to how much money you put in. So the fact is you put in this extra money, you get a proportional additional amount of cash value. There's nothing really in the cash value for me to talk about other than the next one, the death benefit. Now, when you look at the death benefit, what you see is the death benefit on face plus fund, because you paid more, gets up to 1.334 million, right? Isn't that a nice thing to have? What age, right? The problem with the 1.334 million and the fact that you get face plus fund is after the payment period, the money continues to be used up to optimize, and it drops down by age 85 to $1 million. So if you die before age 85, you get this bonus. You paid a lot for it, but you got it. You could have done it cheaper with term. But if you get to age 85 and they're equal, there's no additional benefit for paying the additional money. You paid all that extra money and got the same death benefit at age 85. The same $1 million protection at age 85 can save you approximately $100,000 in mortality charges. The lower net amount of risk, check those declining numbers. Yes, there's a trade-off, giving up the additional death benefit until age 85. But here's the engineering perspective on optimization. We're not just looking at the insurance in isolation. We're designing it for a complete financial system where living longer is the desired outcome, despite the fact that one guarantee we can't offer, how long you're going to live. The other assets, home, CPP, OAS, gain time to appreciate, go up. And the insurance becomes one component of a balanced long-term plan. It's like designing a power grid. You don't optimize just one power plant. You optimize the entire system for long-term efficiency. Now here come the numbers. This is what I wanted to show you. Net amount at risk. So look at this. This is the part that we're getting to. The amount they're going to charge you for is the difference between the death benefit and the cash value. So the net amount at risk under flat face starts at $987. They're only charging you the same mortality cost for a smaller amount. And look how the flat face goes down and down. You're saving more and more as the price is continuing to go up. And if you look at mortality costs, you can look at mortality costs and say, wait, face plus fund is full pop. Flat face gives you these discounts. And if you add the flat face up and the savings on mortality costs, you're paying about $100,000 less in mortality costs. So that's the math. I know I'm throwing a lot of stuff at you today, but I think it's important that you understand net amount at risk is something that makes sense when you're looking at YRT to age 85 on a level face amount because of how much money it saves you. It doesn't apply to level cost of insurance. It doesn't apply to par that I can think of in any way. But here is where you can get the best deal for life insurance because you understand net amount at risk. Can we compare guaranteed mortality costs? Yeah, we can compare and we can shop. I do this all the time, but here's an example, right? I highlighted in yellow who has the best rates. There's Manu, there's Beneva, there's Equitable. There's a 35 male non-smoker. I might have done this a year ago. So don't hang too much onto this, but you can do it. They publish every mortality cost in their material. So we have this, right? YRT mortality costs are guaranteed in Canada. I would contrast that with the US. They don't guarantee their mortality costs. You got to pay a lot to get guarantees in the US. This is the beauty of being in Canada and having access to our products. The best guarantees that I see in Canada or versus the US market. And the warning is you always have to read the fine print, go through the contracts, which we do, right? And you got to wonder what's buried on page 37 of the policy contract. And we review policy contracts. So the final question, who has the best lowest cost YRT-UL product today? This is the best. If this is the lowest cost, if this is somebody says, I just want $1 million of insurance permanent, get me the best deal. We call it non-par option when we're doing our analysis of the diversified portfolio. Here's the chart. This is old. It's from November. I didn't see any reason to update it, but I could go through this again and we'll continue to update these things. To design the best YRT universal life product in the marketplace, we have criteria and we weight them. And here they are. We look at insurance costs. 40% of the challenge of getting the best deal is getting the lowest insurance costs, guaranteed. I put a lot of weight into the investment options, which is why I'm talking so much about the PAR investment fund, which I think is a game changer for all of us. We can add stability to this program. And I look at upside potential, some things that they might have in their contract that make it more valuable. And there we go. PAR investment fund in the Manulife product gives me 5 stars. I don't know, maybe there's a different symbol, 5 check marks. And Manulife has a great product right now. Now, on any particular situation, you can go deeper. But I was looking at these as well, and I liked what Sun has done. They're a YRT to 85. They have different versions, but this is where we want to go, A, to differentiate ourselves, and B, to put the consumers first. If you don't look at the market and you call yourself a broker, I don't know how you're safe from criticism in the future by not knowing the different products and what the contracts say if you're a broker. So that was it for today. I hope you enjoyed it. Class 46 of 50. We're getting near the end. This was called Net Amount at Risk. And each week I sort of show you the 5 most important things I wanted you to know today about how we reverse engineer products and how it fits into a life insurance design and what the math tells us about net amount at risk and how can we compare mortality across the market. And finally, who has the best product. So thank you. Next week is going to be just as exciting, I hope. And we're coming near the end, and then we'll start again in 2025. That's the end. Now I stop, and I wait for you people to tell me what a terrible job I did.